So thank you very much, everybody, for joining today's webinar on purchasing investment property opportunities and challenges. In terms of today's speaker, there's myself. I'm a partner in Grant Thornton. I also head up Grant Thornton Pension Trustees. We set up and administer small self-administered pension schemes, and in a particular focus on the purchasing of investment property through these pension structures. So I will talk around that for about 20 minutes or so. Ray McMahon is a director and chief operations officer in Dilliscan ITS Mortgages. They're the primary buy-to-let lender in the country, and they're active lenders to pension schemes also for property purchases. So Ray will talk a bit about how he approaches that market and the provision of finance therein. Enda McGuan is Managing Director of Winters Property Management, one of the largest property managers in the country. And Enda will talk about the investment market, I think with quite a regional focus, but I understand we'll cover it nationally from a residential and commercial perspective also. So just to kick off on my side, and just to say we will be sharing the slides after this this presentation, and there is a question and answer function there at the bottom of your screen, and feel free to ask some questions there, and we'll allow a bit of time at the end of the presentation, maybe 5-10 minutes. So we'll aim to be kind of 20-25 minutes each on the presentation, and to be completely finished by 2 o'clock. In terms of GT, we have close to 1,500 employees, offices around the country, and there's some stats on who we are in case you didn't know us. So in terms of purchasing investment property, I like to put the available options into 3 broad camps. Okay, so if you've gone out to buy a buy-to-let, whether it's residential or commercial, and let's say you're an ordinary person, I'm not talking about ICAVs now or big property institutional property funds. I'm talking about ordinary folk here. You've really 3 options as to how to purchase investment property. First option is personally, and I suppose what we see on personal purchase of investment property is that the tax system now does not really encourage investing in this manner. So not only do you have to withdraw monies from your source of income, your employment or trade, and be taxed quite heavily, in excess of 50% higher marginal rate on the tax. So actually starting out with sufficient money to invest is a challenge, but also once the property is purchased, that there's now much enhanced income tax on the rental income, and CGT at a higher rate. It used to be 20% an hour, but up 33% on gains. And we did have an ecosystem there of capital allowances around the country where you could buy property and basically purchase a tax shelter along with that property that would shelter you against other case 5 income, or even in some cases case 1 and 2 income and Schedule E income, which is salary and other trading income. And really that landscape is much diminished in line with the last 10 years, and I suppose that political move against subsidising property purchasing. So people have looked at other options, particularly this time of year when the Form 11 income tax form goes in, and a really huge bill for case 5 rental income on investment property. People wonder, how efficient this is to purchase investment property. More popular of late has been use of a company or special purpose vehicle company to purchase property. I suppose the reason here is that oftentimes a company can be part of a group. It may be easier to move monies from a trading company within a group to a propco, a property company, if you like, so thereby avoiding that initial first hit on withdrawing monies from a company in order to invest. But also the corporation tax rate is lower income tax. So while the challenges around surcharges on the income, the rate is less than income tax. But at the same time, there's further challenges on extracting monies from the company. 2 hits to capital gains tax, if you like, once on the sale of the property in the company, and again on perhaps liquidating the company later on. But again, a more popular vehicle, and something perhaps to look at for a serial investor in property, somebody looking to build a portfolio. My focus today is on the use of the pension structure, whereby we talked about the clawing back of capital allowances and reduced reliefs, but the pension infrastructure has remained relatively intact the last number of years, and perhaps it's because the word pension is there. It is somewhat protected in terms of a tax relief, but it's a very generous tax relief. And effectively what happens is your employer is able to make contributions into your pension, and this full that there's no BIK, no tax on transfers into your pension. So if you have €20,000 in the company, and which is your employer, and it makes a contribution to your pension, there's no deduction of tax. That 20,000 remains 20,000 to your pension. Once it's in your pension and you've purchased a property, the rents come into your pension bank account. There's no tax on the rents. There's no tax on the income. You sell that property for a gain. There's no capital gains tax. So within the pension structure, you're in a tax exempt structure. It is tax is deferred until the point of retirement, at which tax is paid on withdrawals only from the pension. But ostensibly, you are in a tax exempt structure, and the ability to invest, receive income and gains tax free really means that wealth can be accumulated quite significantly if there's any kind of return in that tax free environment. There is a 2 million standard fund threshold, which means that you can fund your pension up to €2 million up to the point of retirement. It's retirement in inverted commas. I suppose it is at a date when you choose to stop funding your pension and to be able to access your pension. Currently, any time from age 50 for early retirement, 60 is held out as a normal retirement age. And at that point of retirement, assets can transfer into what we call an approved retirement fund, which is an ARF, which is held until death, and assets continue to grow tax-free in a very similar structure. There is tax on distributions. At first, there's a tax-free lump sum, generous in terms of a quarter of the up to a quarter of the 2 million standard fund threshold can be withdrawn, much of it tax-free, and then after that there is tax on distributions from the ARF in the future when monies are withdrawn. So just to take a step back on the on what the pension is, I suppose there are 2 main types of pensions. There's kind of a standard pension offering that is open to most people, and by law all employers must offer a PRSA offering, but these pensions tend to be somewhat restricted and tailored more to employees who are perhaps not as sophisticated in investing, so they tend to be regulated funds, and perhaps the growth or the lack of growth in these funds sometimes is a function of the regulation and the costs, and perhaps there's a lack of choice, but all being meaningful in terms of being tailored and suited towards your average employee. The self-administered pension offering traditionally has been more focused on senior managers or entrepreneurs, company directors, senior company management who maybe want more choice in terms of what they can invest in, maybe want to be more hands-on in terms of what they can do to drive greater returns and build up wealth. Significantly, it allows unregulated investing. which includes direct property, residential and commercial. Other kind of property setups that we see are syndicated investment properties, so going in with groups and co-owners. We see the use of loan notes to other investment vehicles from pensions. Of course, the coupon or interest rate is tax exempt in the pension. And we see a much broader architecture of investments that can be done, not just property, but subject to some revenue rules across the board, wide architecture in terms of what can be invested in. Of course, because this is a tax exempt structure, revenue are very keen to ensure that rules are followed, and for this purpose they insist that a pension trustee be appointed to jointly administer the pension along with the beneficiary. So really it's a kind of a hand-in-hand procedure where the pension trustee, which is ourselves, Grant Thornton, would ensure that revenue rules are being followed. And we'll talk to the availability of debt through Ray's presentation later. In terms of the different kind of pension structures that have the self-administered option, really there is a broad array there, both for employed individuals employed by an employer, generally a company, but could be employed by another individual. This is the most common route we see for ability to fund pensions, because it's quite generous in terms of back funding and the manner in which employer contributions in particular can be made. We see self-administered options, the likes of the self-administered PRSA as an option, somewhat restricted in terms of what can be funded at the outset in a self-administered PRSA, but there are some significant benefits of PRSAs for later on nearing retirement. The self-administered PRBs or BOBs, where you're transferring from other employment. And then I spoke about the approved retirement fund, or ARF option, which is a post-retirement vehicle that is widely used and widely used as the self-administered option. So we generally see the first one, the employed or the employer making contributions, perhaps from a company, into a pension. And we see the use of the ARF in particular very, very popular for post-retirement vehicles for self-administered pension. I just want to run through a case study which I've presented a number of times. You may have seen before, but I think it's very pertinent in terms of the comparison of personal investing versus pension investing. So in this instance, over a number of years perhaps, or in one go, cash has built up in a company, and the beneficiary or the shareholder or the owner of the cash wants to invest in their personal name, but unfortunately they have a very significant tax bill here, 52% tax on withdrawing funds from a company. As I say, it could happen at once, or it could happen over a number of years through salary, etc. So in this instance of €250,000, we're left with 112,500, which is 48%, if you like, post-tax monies available then to purchase an apartment. That apartment is bought for in around that €100,000. There is a rental return that is probably an average return in the market. The problem with this is that the rental income is also taxed at the higher rate of and it could be up to 52 or up to 55% in certain cases. So in this instance, €3,000 on 250,000 doesn't seem like a great return, and the rents will be taxed constantly every year, and there will be capital gains tax on any gain. Look at the pension side though. Cash over a number of years or in one go was withdrawn from the company. The company made a contribution into the self-administered pension. If you like, now there's double the amount of money. 2 apartments are bought, twice the rental income. We look for a property agent to be involved here, and we have a trustee fee also. So it'd be remiss of me not to include that, although I would hasten to add that any serious property investor should engage a property agent, because the rules around letting premises and the PRTB rules are much enhanced than before, much stricter than before. Penalties are quite high. It's really moving much more professional landscape. But in this instance, because we have twice as much property that we can purchase, we didn't have the initial tax bill, and because we don't have the second tax bill on the income, we're actually ending up with kind of 4 times as much return as if we were setting out ourselves. And obviously, we've no capital gains tax on a gain there either. There are, of course, some rules around the tax exempt structure that Revenue insist are followed. One is the arm's length requirement. So this is where you would purchase at arm's length. You wouldn't sell a private property owned by yourself into your pension, and ditto for connected parties. Why? Well, you might overinflate or underinflate the price. You might abuse the tax exempt nature of the vehicle. But this is for investments only. Okay, so operating a trade through your pension is not allowed. Okay, that might sound obvious, but if you're a builder and you're building a house in order to rent it out, well, that's an investment. But if you're building that house in order to sell it on immediately, well, that might be a trade. So there can be a subtle distinction there, where property development for onward sale is not permitted. Of course, property development for holding and renting is permitted. So it's investing versus trading. There are some restrictions on direct investments from pensions into private companies. These are non-market floated companies. These are companies where there might be a liquidity issue if significant investments were made from the pension into those companies. And to follow on that theme, Revenue have a general rule around sufficient liquidity to provide assets in the future. So they want to ensure that investments in, for instance, land has good title, and that it can be sold, within a short enough period. When I say short enough, I mean a year or two. That kind of liquidity. Revenue do not want to see investments tied up in illiquid investments where the money cannot be gotten back. In terms of bringing some borrowing into the equation, and Ray will talk to this later also, but let's look at the previous example where we had 250,000 over a number of years. We paid a heap of tax, and we had 112,000 left after we paid the tax withdrawn from salaries or tax deducted bonus, etc. We went to one of the buy-to-let lenders on the main street, let's say, and we borrowed some monies there, 55% loan to value. So now we're back up to the 250,000. We buy 2 properties. We have our income tax bill, but also we have to repay capital and interest on the loans. Okay, so we're in a situation now that because of the high taxation and because of the capital and interest, that there's insufficient overhead to cover both from the rents, and we're in a position where we have to subsidize the bank and the tax bill. And by the way, that minus 3,000 figure is an after-tax figure. So if you're trying to fund that from salary, you'll need 7,000 or so, perhaps, of salary to fund that deficit. And probably one of the reasons why people are exiting the buy-to-let market from a personal perspective is that they have been subsidizing the deficit for years, and from a cash flow perspective, it's really not making a lot of sense, even though when perhaps the equity that they have in the properties may be grown over the years, the cash flow is just a problem. And it's a problem too for the banks, because there's insufficient headroom to lend on the properties because of the higher income tax. So they're less willing. It's one of the reasons why they're less willing to lend. Let's look at the pension though, and as we discussed, there was no taxation on the transfer of monies, the contribution from the company into the pension scheme. Okay, Ray will come along and lend to you at 50% perhaps, based on where the property is, etc. He'll talk to that. You now have twice as much again to invest. So you go off and buy your four properties. Yes, we insist on an agent being there and some trustee fees. However, because you have no income tax, you have much more headroom then to service your capital and interest debt repayment. So in this example, we have a surplus. So from a cash flow effect, it's enhancing. Obviously, the equity is increasing all the time. The debt is being paid down, and because you have twice as much again property, if you're experiencing capital gains, then they are magnified as a result. Obviously, the same concerns around too much debt. I would say this is very conservative. What's on offer in the market at the moment, at much more conservative levels than historically. But the same goes if prices drop. I suppose your debt magnifies, but that's the same situation as for any property investor. Revenue have some guidelines there, but really they're stacked against the lender. The lender's not allowed to take recourse security over any other assets. They can't get an assignment of rental income. No personal guarantees are allowed. The plus side for the lenders, of course, is they have much more headroom because there's no tax to service their loans, and there's a few other items there that you'll be able to read. In terms of the opportunities that we see, well, we see multi-tenanted properties. So these are buildings with multiple apartments in them, or maybe commercial units in them. We see both residential, commercial properties. Residential would seem to perform quite well, and we'll talk to that even in COVID. Commercial property might be another story, particularly around retail and hospitality. And we're seeing huge demand from government for social housing, and they really have embraced the buy-to-let investor in terms of offering good rents in return for social housing, and sometimes for longer leases, longer contracts. So relatively light touch management of investment properties by investors. As mentioned earlier, we're seeing joint investors coming together in co-ownership, so larger syndicate investments, 3, 4, 5, 6 investments, and the use of loan notes sometimes for investments in property companies. But the direct route for purchasing buy-to-let property is most popular. So the takeaways before I pass on to Ray is that we're saying that the company structure, so having an employer make pension contributions into your pension is really works best from a tax efficiency and ability to fund perspective. Somewhat more restrictive with personal pensions, but when a company makes the contributions as part of an occupational pension scheme, then we find this works really well. The self-administered structure, much broader flexibility, much broader options versus an insured pension that really can be quite limited in terms of the numbers of regulated funds that a beneficiary can invest in. We'd be saying that the property provides a yield and a return, and may be suited in retirement in terms of providing a regular income from a portfolio in order to live off in the future. So perhaps not a bad asset, cash generating to assist with retirement income. And if you are looking to invest in property, I would say look at the pension options first. It is the most tax efficient of all the options that I've set out. So in that regard, what I will do is I will now pass the screen over to Ray, and Ray can talk about his offering there. I can remember how to do it. Remote control to Ray. Ray, have you got that there?
Yeah, thanks very much, Angus. Yeah, that's great. Let me just go back to the slideshow. Okay. Yeah, perfect. Okay, great. Thanks very much, Angus. Good afternoon, everyone. So my name is Ray McMahon. I'm the Chief Commercial Officer of ICS Mortgages. And what I'd like to do today is just give you a brief overview of our business, and then to talk through the pension unit trust buy-to-let mortgages that we provide. So in terms of our business, the business was effectively established in 2013. Dilosk is our parent company, and we acquired the ICS Mortgages brand from Bank of Ireland. In 2017, we launched our buy-to-let lending product, and we now, I'm delighted to say, have over half of the new lending market. The figures that get reported for that market don't include lending into SPVs or into pensions. So the actual market is quite a bit larger than maybe what you read in the newspapers and what gets reported, simply because we're seeing more and more people buy property through SPVs and through pensions as well. In September of last year, we entered the owner-occupier market, and delighted to say that that's going very, very well. We've a particular niche around public sector employees, and we've been very, very pleased with that. And again, our distribution channel for these types of products are through our direct channel or through our broker channel as well. I think the screen seems to have. Let me just go back here. I don't think I've got control of the screen anymore here, Angus.
Let me just try again. Sorry about that.
Okay. I think we're back. I think we're back on track. Okay, I think that's fine. Okay, thanks a lot. It's probably just telling me to hurry up and get on with it. So just moving on to this is kind of.
See how you go there, right?
Okay.
Click on the screen there.
Yeah, great. Yeah. So
yeah. Okay.
Thanks a lot. Okay, so in terms of our target market, we lend to established landlords. We lend to new property investors. We lend to SPVs, pensions, individuals, and in terms of individual lending, we do up to 4 individuals on a mortgage. So we've seen, particularly for people getting into this space for the first time, that's been quite interesting. We have within our buy-to-let facility, our pension unit trust offering, there are certain criteria within that are key for this business. One is that it is really for the purchase of residential investment properties, first and foremost. We will refinance existing loans within within structures, but primarily it is used for purchasing of properties. Our product is a up to 15-year capital and interest product, up to a 50% loan to value. Minimum loan size is 40,000 up to a maximum loan size of 500,000, and we've no cap on the value of the actual asset itself in terms of the property. Minimum term is 5 years, max term is 15 years. Our rate is 4.25% variable rate for capital and interest. And that is effectively a non-recourse loan, because we only have recourse to the asset itself rather than to the individual or to any other assets in the pension unit trust. Minimum property value is 100,000, and again, as I said, no maximum property value. In terms of the lending criteria, it's a key feature for us that we need the property managed by an independent third party. In terms of value for money, we think that proposition makes a huge amount of sense, and just the independence and oversight and the expertise around managing these properties now with increasing regulation from the the Residential Tenancies Board and other regulations, it's just important to have very, very good advice around that. The lending criteria also covers the fact that it's only really for one investor or one beneficial owner is allowed for each sub-trust fund. We can refinance debt from existing pension funds, but we will require evidence of the original purchase transaction within the fund. Under revenue guidelines, again, we do not provide interest-only loans. And then a copy of the overall liquidity position is key for our credit team. So effectively, what they want to see is that there's sort of comfortable headroom within the unit trust, that if there's any sort of fallow periods within the first 12 months, that there's effectively sufficient cash to cover that within the pension structure, and that no arrears are recorded within that. Our recommended requirement is for 12 months of mortgage repayments to be available within the fund, and up-to-date financials for each of the property unit trust need to be provided on a yearly basis. Moving on then to the borrower profile. So the applicant must reside in the EEA. The reason for that is because of how we fund ourselves. We fund ourselves via the bond markets, and the European Central Bank buys a lot of these bonds One of their rules is that the residents need to be resident in the EEA. So sometimes you see some of these rules and maybe, on the surface, they don't seem to make a whole lot of sense, but in many cases, the reasons are driven by, the funding requirements on the other side of our business. The buy-to-let property itself must be located in the Republic of Ireland. And again, as Angus pointed out earlier, it cannot be used as a principal private residence. All applicants must be the owner of at least another residential property in the state. And again, that is really to avoid a situation where people are buying a property through their pension and then using that for their own accommodation needs, which again is prohibited by revenue. Again, it is non-recourse lending, and we require a valuation on each property before before loans are drawn down. Because this is a buy-to-let property, we focus very much on an urban product. So we have set a limit of, population centres of 10,000 or more. That's based on the 2016 census. The next census is in 2021. So you'll see some towns that were outside of that will now actually fall inside of those limits. And there's about 16 towns in Ireland that were in that 5,000 to 10,000 category in the last census. And we think maybe about 4 of them will actually be over the 10,000 this time next year. So you'll have places like Gorey, Shannon, etc. coming on stream, which makes that pretty interesting. In terms of the lending criteria, we need 75% of the rent to cover 1.2 times the scheduled repayment. That's our debt service coverage ratio, pretty straightforward. The gross rental income from the property, together with surplus disposable income, should equal or exceed the scheduled repayment, and stressed for the contracted rate plus 2%. And again, that's a regulatory requirement that we have to adhere to. We also have some concentration limits. So if people were buying multiple properties within one development, there are concentration limits, but they're pretty rare, and we don't come across that too often. And then in terms of age constraints, minimum age of application is 21 and maximum age is 25. The fees around that, then we have €1,815 plus outlays. There's an application fee of 0.5%. And again, sort of maximum loan amounts are covered off, as mentioned earlier, and that 4.25% rate is effectively non-recourse. Moving on then to the actual application of this lending. So we work very closely with our approved trustees, and Grant Thornton very much at the top of that list. And we encourage all of the customers, all of our beneficiaries, to get independent pension advice before engaging in any of this lending. And really, this is, in our view, it's the most effective way of owning property, is owning property through one of these unit trusts. The benefit of the gross roll-up, the benefit of the structure, it's so tax efficient, and it's just a very, very efficient way of growing a property portfolio. So we also have a specialist buy-to-let refinancing unit. So for people that have existing properties outside of pension funds or within pension funds, always happy, where they've got funding away from us, we're always happy to engage in a conversation to refinance some of those portfolios. And in fact, if you look at a lot of the lending that was done pre the last crisis, and certainly in the sort of 2001 to 2005 period, a lot of people were signing up for kind of 20-year IO loans. A lot of them are coming through to maturity in the coming years, and we'd be very interested in having a conversation about refinancing some of those loans within pension structures. So this next graph is just an interesting representation of the types of assets that we're financing at the moment. So this is a matrix across all of the postcodes in Dublin and every county in Ireland that looks at the yields on 1 beds, 2 beds, 3 beds, and 4 beds in every county in Ireland and every postcode in Dublin. And you can see it sort of at one end. If you look at the bottom right of the graph, you'll see sort of Dublin 4, Dublin 6, where yields are in and around 3% for a 4-bed property. And if you look at sort of the top left of the graph, where you can see places like, Cavan, Longford, Donegal, where you're getting sort of 10 to 12% returns for 1-bed apartments in those jurisdictions. some of these yields, it's a very, very interesting graph, because it just means you can very quickly look at a matrix like this and sort of cherry pick interesting jurisdictions and interesting assets within those jurisdictions. So some of the things that really stand out, sort of 2 beds in places like Limerick and Cork. If you're looking at, towns like Sligo are very, very interesting, where you've got, hospitals, good, sort of infrastructure, transport, third level education, all of those. Again, look, it's a very urban product, an interesting feature just to have a look at in your own time. But there's lots of sort of interesting, metrics in that graph. The market itself is also quite interesting. If you look at the average age of a person buying property pre the last crisis, so pre the global financial crisis, it was sort of, mid to high 30s, and it was very much a speculative buyer. Because of the macroprudential rules, the speculative buyer is effectively gone out of this market. For just a standard buy-to-let property, central bank rules, require a 30% deposit. For that reason alone, we've seen the average rate of a purchaser for our landlords, inside and outside of pensions, is 52 years. And there's been a lot of work done by the ESRI, but the CCPC as well, around why people are investing in property, and it's predominantly to fund pensions, and that's reflected in the age of these borrowers as well. So we're acutely aware that that is very much the focus market for us, and we spend a lot of time on that. At the same time, we've also noted that there's an ever-increasing number of our customers that have more than one investment property. Just talking to some of the estate agents recently, I've heard figures of between sort of 20 and 30% of the properties on the market right now are coming from people who are exiting the buy-to-let sector, but they own property outside the structures. That the tax treatment that just isn't especially efficient. You compare that to the demand that we're seeing for people buying properties within tax efficient structures, and none better than pensions. It's quite a stark contrast. Just wanted to point out as well that we've got quite a few guides available on our icsmortgages.ie website. So we've got a guide for property investors, a guide for people looking to refinance portfolios. All of those are there and freely available. So look, thanks very much for your time, and I'm happy to take some questions at the end. I'll just pass this back over to you, if that's okay, Angus.
Over to you, Enda.
Thanks, Angus.
To just scroll down there again.
I have control slideshow. Okay, so I should be able to move this through. Yeah, it's working now. So thanks very much. So good afternoon, everybody. Thanks very much to Ray and to Angus for the lead into this. Obviously, I'm and the business I represent. We're the third leg on the stool in terms of the construct that the guys have presented today. I suppose obviously the structures, the pension structures that GT have outlined, and obviously Ray and Dillis, the products they produce. Part of our role then falls into identifying opportunities, and also, I suppose, putting management structures in place that allow, good yield and good capital appreciation over time. There are a couple of points that are relevant from what Ray mentioned, which I'll deal with today in part of my talk. That point he mentioned about yield. I have a number of case studies which will hopefully illustrate that a little bit more about some of the regional centres. Also, the opportunity that is there at the moment. We have 20 to 30%, as Ray has identified, is quite correct. That represents a lot of the people that are leaving the marketplace right now, but that does present opportunities for people looking to buy in, particularly buy-to-let, because the demand for buy-to-let has never been less. So essentially what I'm going to try and give you in the next 10 minutes or so is a very brief overview of what's going on at the moment. I'm going to take a look at some of the trends in the 4 key investment areas, and then I'm going to look at some case studies, and ideally with the case studies, I'm going to give you some takeaway information on these that you can look at depending on the geographic area you're interested in and where you come from. And lastly, I'm going to talk to the due diligence aspect, what you should look out for, what are some of the pitfalls that you can encounter. In terms of ourselves, the business I am the managing director of Winters Property is long established. I won't go into the details, but one thing we have moved into in the last couple of years in particular is the area of consultancy, and specifically in the area of alternative residential investment. And these are opportunities in areas like purpose-built student accommodation, in PRS, as in buy to build to rent properties, and also in some trends like elder living, which are coming down the track. And I suppose the reason I highlight these right now is because the key thing about property and making decisions on property is identifying where the opportunities are, but also looking where the broader economic environment is and where is it going. Property obviously is only a function of the broader economy, and obviously it's influenced by lots of things. And I like these sets of slides up here because it illustrates that point. So essentially, first off, the one slide on our right that I'm highlighting here illustrates the Irish population, and it shows where it's going and where it's what direction it's moving in. Obviously, we have a population which is getting older. We also have a gap in the middle, and I suppose there are two things this highlights to me. One, we will have a greater requirement for elder living opportunities, but also immigration is going to become a bigger issue as more and more workers come into the country, and I'll talk to that in a little bit. So the second one up here is more about owner occupier rates, and that illustrates from a residential perspective how things have changed over the last number of years, and it illustrates a trend in terms of how we live. And then lastly down here, it's the family or household formation stats, and you can see it's down here at about 2.5, 2.6% as the average size of a household. What that indicates, and for you as an investor considering residential property in this instance, it is what type of property is going to be popular. So Angus may have touched on the opportunities in social housing at this stage, the investment that the government is driving in that direction. What we see is some of the biggest demand is in the area of smaller properties, 1 beds and 2 beds, which help to address the needs from smaller households. So I suppose numbers are key. And again, some of you may be familiar with this. This is the National Development Plan. It illustrates the growth in the city population over the next 20 odd years. While obviously we're in the midst of COVID, sometimes we tend to get caught in the fog of COVID and don't look to the future. This is the direction that our city populations are going. And this is going to have implications for how we live, how we work, how we play, and as a result, implications for the type of residential properties in demand, where are they going to be located, also in terms of office, retail, what office demands are required, and what retail space do we need. And I suppose lastly, from an information perspective, I put this up. I'm talking today about lots of cities, but I suppose I put this up because it's convenient for me, because I'm based in Galway at the moment. What we've got right here on the screen illustrates the future. So the road to our right, in red, the road on the top of the screen is a potential bypass of the city. What we also see here in blue is a new bus corridor for the city. Obviously, both these factors are 5, 6, 7 years out, but they will have a huge impact on where people live in relation to this city. And I suppose, and also where they will work and how they will work. So I suppose for you as an investor, you need to do your work in terms of considering buying property, whether it's commercial, residential, retail. You need to look at what's happening in the environment you're looking at and what opportunities are going to be presented by external factors, such as roads, such as planning, such as other issues. I suppose, so moving on then to get into the more specifics of the various property classes out there at the moment. I'm not going to go into the stats in detail, but I'm going to try and provide you, as I said, the overview of the trend. So there you can see on the screen the actual rents as of the last couple of weeks for office space in the major cities. I suppose what we are seeing at the moment, and the concern for you as an investor may be based on, well, are people going to continue to work in offices, or what are they looking for? So from a property professional perspective and advisory perspective, what we see right now is that people are still demanding space for two reasons. One, because they can put less people into their office space. They need larger spaces to expand into. I suppose the second thing is that people are also looking to the future. The home working trend, which we all participate in at the moment, and which I do myself, is something which is going to be here to stay, but it is unlikely to be in a 5-day situation. The key thing that a lot of business people, when you talk to, and many of you are those yourselves, the encounters that you would have in a normal day in a workspace where you solve problems are not there working from home. And Zoom, as this medium, is an excellent way of communicating. We're from all over the country gathered here today, but to have those detailed conversations, you need that visible presence. And I think so the support and I suppose the direction of office space is still going to be positive. Having said that, for you as somebody looking at office space, you need to bear in mind some other factors that are now becoming very important. What is the quality of that office space? And we see from a valuations perspective that valuations, offices that have good quality ventilation systems, and can demonstrate compliance with COVID restrictions and ongoing COVID restrictions are seeing increases in valuations. Older stock is struggling a little bit, but then again, when that happens, it also presents you an opportunity to refurbish and to look at new opportunities within that stock to bring it up to standard if you get it at a good price. So I suppose, look, these are trends we're trying to illustrate here as part of this today. So we move on to industrial. This has without doubt been the strongest performer in 2020 of all property sectors. And it's largely been driven by the last point I have here, which is this online retailing and the last mile delivery. Essentially, as we have been forced to move to online retailing and purchasing, getting product to as close as possible to your house, that last mile as they call it, is the crucial factor in keeping costs low. So prime industrial space has gone through the, I wouldn't say through the roof, but has held up very, very well, and growth has been very, very strong in it throughout the last 6 to 9 months. And this trend, obviously, that COVID has accelerated, is a trend that was always there, but it is something we're going to see growing more and more. When you look at Ireland and the UK by comparison to Europe, we're still 20, 30, 40% behind the level of online sales that countries like Germany and France would have had prior to COVID. So we're accelerating as we catch up, but it is definitely having an impact on office and on the industrial space, particularly in adjacent to the motorways and our new motorway systems. Again, moving on then to retail, the much maligned retail, if I can call it that, because again, there's a lot of doom and gloom talked about this sector over the last 6 to 9 months, but you have to look at things into perspective. So the key factors we see is that location. So when you talk to professionals in this space, they will tell you that particularly regional shopping centres have gone, their sales, their footfalls have gone through the roof as a direct impact of COVID. Because people were less able to move into city centres, they've now shopped locally. So these smaller suburban centres or rural centres are now performing very, very well. In addition to that, I suppose we also see changes to the type of way people deal with, we utilise retail. We're seeing the larger shopping centres are likely to be more purposed towards destinations, as in you do a certain amount of shopping. In cases of the younger population, what they will do is they will try on clothes to go home and buy them, but they will spend within that retail space or that shopping centre space on coffees, on recreation. So that trend, so the big ticket shopping centres you're used to looking at in Dublin city centre and Cork and Galway are going through that transition right now. So I suppose that's important to bear in mind when you're considering investment. And the last thing I will say, high streets obviously have suffered considerably at the moment. But I think the one thing we are seeing is that there is a government policy towards the repurposing of these units and the opportunities that presents to turn these into retail, to turn them into digital hubs, various other opportunities. And for an investor, you should need to be alert to these sort of trends. Lastly, I'm going to deal with is the area of residential. And I suppose residential has always been popular within this pension framework and within borrowing that Dillis can Ray provide. I suppose I put something up here. It's a report we've done ourselves because it highlights the importance of data. The key thing you need to get is good information. So there are various reports out there at the moment talking to trends, and one was last week which talked about a 4.8% year-on-year increase in rents in the Galway area, just to use that example. We know, as somebody who operates in that space, because we have a database of rents of all types of properties, that the actual year-on-year change in paid rent is 2.4%. We know how the impact of rent protection zones have had, and I suppose the key point I'm making here is the RTB will produce some stats. They'll be out in the next month, which are based on actual rents paid over, and they should be, those and other reports should be used together to provide an idea of what the trend is. Because with the amount of legislation that has come into play in the property sector, particularly in residential, we've just seen today that the rent reviews are likely in residential to be restricted again until April because of COVID. You need to do your work in advance to decide what's a good opportunity. And I suppose that then neatly brings me along to some of those sort of opportunities, which I'm going to put through on the screen here. There's a large amount of them. I've got 7 of them. You can take them away to review them yourselves. I'm not going to go into each of them in detail. What I will say to you all is that these are current properties, either on the market with current rents, but I will have put a few caveats on some of them. So this one is in a purpose-built student accommodation scheme. Now, at the moment, this sector is undergoing a little bit of turbulence because of the challenges that students face in going into colleges at the moment. Occupancy rates are poor, and that's for this academic year. However, what hasn't changed is the demand that is underlying that. And what I'm saying by that is that the numbers of students are not going to decrease over the next 4 or 5 years. They're factored to increase. So I suppose this may be an opportunity to get additional value in purpose-built student accommodation or in sites that are traditionally student accommodation, as people may take this opportunity to leave the marketplace. Again, I'm talking about taking that long-term view post-COVID. Similarly here, this is an industrial unit I've utilised just to illustrate the type of rents and the potential yields that are there at this moment in time. Again, from a commercial space perspective, people are taking a pragmatic approach right now about the rents they have put in place. Getting a tenant in is challenging in the commercial environment at the best of times. In the current climate, it's more difficult. So people are looking at, and yield is being compressed a little bit as a result. This one, and is very important, highlights the challenges of navigating an investment through the current legal environment. So these are 2 units, absolutely identical, 2 identical 2-bed apartments. One is rented at a rate of 9,672 and the other is at 12,780. These are within a rent pressure zone. So these rates are fixed. So where you might pay the same price for these properties, 190,000 euros, the actual yield that you can derive, because it's in a rent protection zone, is dramatically impacted. So one is a better opportunity, it's is less, it's 5.1, the other is 6.7. Right now, under the rent pressure zone legislation, you can only impact either of those 2 figures by 4% as a max. And as I mentioned earlier, the likelihood with COVID regulations, rent reviews will be restricted until April. So when making that decision to buy, you need to get a good history of a property. Again, opportunities I presented here in the regional markets, which I think Ray touched on earlier on. This is a 2-bed in Cork with a potential yield of 9.7%. Here's one in Limerick, a potential yield of 10.4%. So people might get put off with the market value price, but I think you have to look at yield and where is the city going to go and what's the likely capital appreciation on a product like that. And I have some figures which will talk to that. And here's further again is Waterford. So I suppose there has tended to be a focus on Dublin as, where you can maximize your yield, maximize your opportunities. That's not necessarily the case. And I could go into greater detail in terms of Sligo and other cities, but we've just kept it tight for the purpose of today's presentation. This is something which talks on a point that Angus mentioned, which is about the opportunities that the government support for social housing presents. I'm not going to get into this in detail, but it's like a ready reckoner that I think you need to take away and consider. These are various schemes that the government puts forward. And depending on the risks that you wish to take on or not, there are various long-term leases that you can put in place. You also get various percentages of market rent. And I think in terms of when you're talking with Ray and the Dillis guys, having something like this as a proposition and to comply with your pension regulation, having a 25-year lease with the local authority at 95% of rent within certain caveats makes this an attractive potential product for a pension. I suppose interestingly, these are figures which I've taken from the Irish Times last week. So what they illustrate are the purchase price that local authorities are paying for properties and the cost of building. I suppose what you need to take from this, which is most important. So if you look at Waterford, the cost of building, and these are 3-bed semis, I think was the average price. The cost is 170,000. The purchase price is 178,000. The difference in terms of it's almost as cheap to buy a property as obviously as it is to build it outright. So this is impacting on the market. In some instances, the cost of when you get to Galway, the price here is approximately 260,000 as the cost of building a 3-bed semi in the city at this moment in time. But again, if you look at it in Sligo, the illustrating point is to build a property is cheaper to go and buy right now. And that illustrates an opportunity that Ray talked to. It's an opportunity for stock supply that's in the city, supply is in the city. So buying is cheaper to build. It now means that you won't see additional stock built in that city for some time unless it's heavily subvented. So look, to come to a conclusion, there's a lot of things you need to consider when getting involved in property, but the key thing is research, which is the bottom point I have here. You need to do your work. You need to get good surveys on property. You need to make sure you get your legal advice on the title and leases. This allows you to de-risk the property. When you go to someone like Ray and go to Angus, you can comply with the regulations that are there. I think from a legislation perspective, you need to be aware of the likes of the rent pressure zones and how they will impact on your property. And then at auctions, you need to read the small print. Some of the auctions that are out there, properties are on auction for a reason. There may be, do your research to find out what's behind it. Speak to various advisors in the area and get that information that will guide you in making the best decision for you and your pension. So look, thank you very much for your time. I think I'll hand you back over to Angus now.
Thanks very much, Enda. And we're just coming up to 2 o'clock. So I see one question in the bar there, and it's a question: is there any update on when the IRP2 EU directive will be transposed into Irish law? So, by way of background, we tend to look at changes to legislation, perhaps mostly from revenue perspective in terms of revenue rules. And what we've seen over the years is the reduction of the standard fund threshold from 5 million down to 2 million, and we've seen some other changes, I suppose, peripheral changes around the pension. However, there is, of course, the regulatory side, and there is an EU directive called IRPS that would seek to transpose greater regulation over all pension schemes. Okay, so have investments predominantly invested in regulated funds, and would also seek to restrict the use of borrowing. So IRPS 1, I think, was about 15 years ago, and the minister in Ireland at the time was able to apply a derogation on small self-administered pension schemes. So effectively, small self-administered pension schemes, which I was speaking about, continue to be able to invest in unregulated investments, including property, and were able to borrow. IRPS 2 is featuring. We have yet to see how the minister wants to transpose IRPS 2 into law and how it would specifically affect small self-administered pension schemes. There is a requirement to transpose it into law for all pension schemes. However, we have not seen how that may or may not impact on small self-administered pension schemes. And to the point here about where that's at in terms of when or how it will be transposed into Irish law, we don't have that. We don't have that yet. I would say that we had articles in the newspapers last week around potential changes in the pensions regime. We get proposed changes every year and have done for decades. Some are implemented, most are not. And I suppose all we can do is work with the current regime at the moment. The current regime allows for unregulated investments, i.e. property, in pension schemes and ability to borrow. History would tell us that any changes that might happen are never retrospective, so they don't change what's already there. So if you like, if you had an investment around the 5 million standard fund threshold a number of years ago, your rights around there were preserved, and you were not limited to the 2 million. So that seems to be a way that these matters are respected. In terms of a question here around limitations on a self-directed pension property investment, which is the thing, self-administered pension property investment, in terms of limit on amount allowed to invest versus existing pension pot size and age and any other factors. So suffice to say is that that there is no limit on what amount can be invested. However, there are guidelines around liquidity, and we have seen, I suppose, entire pension pots invested in one investment versus a spread of pension pots. And really, our role as pension trustees is to ensure that revenue rules and regulation is followed. But I think this is where the value of a financial advisor comes into play here, particularly in terms of the age profile of the investor, and at what point maybe that investor wants to be able to access funds. To what level of portfolio or wealth does the investor want to build up to? So they were the two questions there. I think there was a third one that was seemingly marked as answered here. We've just gone 1 minute over the 2 p.m. time, so if you don't mind, I might thank Ray and Enda for joining us today on this webinar. And thank you everybody for also attending and listening on the webinar. We will distribute the slides after this call, and thank you again for attending.